What if I told you that Bitcoin could be just weeks away from one of its most painful drops of 2026? Not 5%, not 10%, but potentially another 28% collapse from current levels. And here's the scary part. The analyst making this prediction isn't some random bear on social media. He's one of the few voices who correctly warned that Bitcoin would break below critical support levels months before it happened. Now he's back with a new forecast, a forecast that suggests Bitcoin's recent recovery may not be a recovery at all. It could be a trap that lures investors back into the market before a devastating final leg down. But before you panic, sell your Bitcoin, there's another side to this story. Because if this analyst is right, the biggest opportunity of the next crypto cycle may be forming right in front of our eyes. And by the end of this video, you'll understand why some analysts believe Bitcoin could fall toward $46,000, the critical level every investor should be watching. Why this summer could determine the rest of Bitcoin's 2026 cycle. And most importantly, why smart money may already be preparing for what comes next. Let's dive in. Let me ask you something before we even get started. Where are you watching this from right now? Drop your city and country in the comments. Seriously. Because by the end of this video, depending on where you live and what time zone you're in, the way you think about what's happening in Bitcoin this week may change completely. Now let's talk about what nobody in the mainstream is fully connecting for you right now. Bitcoin is sitting at roughly $63,000 today, June 8th, 2026. And if you opened your app this morning and saw green, you probably felt a small wave of relief, maybe even a little optimism. That is exactly what concerns me about where we are. Because relief at the wrong moment in a market cycle isn't a signal that danger has passed. Sometimes, and this is the part most investors never understand until it's too late, relief is the danger itself. This video is going to walk you through something that a growing number of serious analysts are warning about. Not the kind of warning that comes from anonymous accounts screaming on social media, the kind that comes backed by data, historical patterns, and a very clear reading of what has happened to Bitcoin over the last 3 weeks. And here's what you need to understand before we go any further. Bitcoin just dipped below $60,000 over the weekend. The first time it has done that since 2024. It has bounced back this morning. But the question every serious investor should be asking isn't, is the bounce real? The real question is, what caused the drop? Has anything actually changed, and what comes next? By the time you finish this video, you will understand 3 things that most people watching Bitcoin charts right now are completely missing. Stay with me, because the next part sets up everything. Let's go back about 3 weeks. In mid-May of this year, Bitcoin was trading around $80,000. Not a level of absolute euphoria, but a level where confidence was reasonably high. Institutional players were involved. Spot Bitcoin ETFs had been a legitimate functioning product for well over a year. There was a sense that the market had grown up, and then something broke. Over 13 consecutive trading sessions, spanning late May and the first week of June, spot Bitcoin ETFs bled out approximately $4.4 billion in net outflows. That number deserves a moment of your attention. $4.4 billion out, gone, in just 13 sessions. That is not a wobble. That is not routine profit-taking. That is institutional money walking toward the exit with purpose. And here's the part that should stop you in your tracks. BlackRock's IBIT, the flagship Bitcoin ETF, the one that became the fastest growing ETF in Wall Street history, absorbed approximately $3.3 billion of those outflows alone. That's roughly 75% of the total institutional exodus coming from a single product that many retail investors had treated as a signal of permanent institutional confidence. Think about that for a second. Hit like right now if that number surprised you, because most people I've spoken to this week had no idea the scale of what just happened. But here's what they're not telling you in the headlines. This ETF bleeding wasn't happening in isolation. It happened at the same time that Strategy, previously known as MicroStrategy, one of the most famous corporate Bitcoin holders on the planet, quietly sold Bitcoin for the first time in nearly 4 years. The sale itself was relatively small, about 32 Bitcoin worth roughly $2.5 million at the time. Financially immaterial, but symbolically, it sent a message that rattled sentiment hard. When the company that built its entire corporate identity around never selling Bitcoin starts selling Bitcoin, markets notice, traders notice, and that noticing translated into pressure. The result? Bitcoin fell from $72,840 in late May to a low of around $59,100 on June 5th. That is an 18% decline in under 3 weeks. And then it bounced. Which brings us to the question you actually came here to answer. Is this bounce the beginning of a real recovery, or is it a trap? Stay with me. because the answer to that question is far more nuanced than most people want to believe. Let me tell you something about how Bitcoin moves that most retail investors learn the hard way. Bitcoin does not reward obvious thinking. When the crowd is bullish, Bitcoin has a long history of delivering disappointment. When the crowd is most fearful, Bitcoin has a history of surprising to the upside. The market operates almost as if it exists to punish whatever the majority is expecting. So here we are on June 8th, 2026. Bitcoin has recovered from its weekend low near 59,000. It is now trading in the low $63,000 range. And already, the optimism is creeping back. Already, the chatter about recovery is starting. And that pattern, that exact emotional cycle, is where some analysts are issuing a very specific warning. The concern is this: what if the current bounce is not a recovery, but a relief rally inside a larger downtrend? What if the market is currently doing what it often does before a deeper move, building confidence, luring participants back in, and then delivering the real damage? Now here's where I need you to pay close attention, because this is where it gets really concerning. The Crypto Fear and Greed Index as of this week is reading in extreme fear territory. That kind of reading has historically been associated with potential bounces, and it has produced the bounce we're seeing today. But here's the critical distinction that most people miss. A bounce from extreme fear is not the same as a bottom. In previous Bitcoin cycles, there have been multiple extreme fear readings during a single downtrend. The market bounces, sentiment recovers slightly, and then the next leg down begins, often more aggressively than the first. The technical picture adds another layer to this. Bitcoin has now broken below its 200-period moving average on daily charts. Analysts who track this indicator closely will tell you that a sustained break below that level has historically preceded extended bearish phases, not brief dips. And if support levels around $60,000 fail to hold convincingly, some technical analysts are pointing to $50,000 as a realistic target, representing more than a 50% correction from Bitcoin's all-time high of $126,198 reached on October 6th, 2025. You need to understand this before I show you what's next, because the macro backdrop isn't helping, and it's something very few people are connecting properly. Comment below right now. Do you think the 60,000 level holds, or do we see lower prices before the year ends? Tell me what you actually think. Here's a question most crypto-focused analysts are quietly avoiding. Why now? Bitcoin fell 50% from its all-time high in the past year. It hit 126,000 in October 2025. And here we are in June 2026, sitting at 63,000. That is a 50% collapse from peak. So the question isn't just what the charts say. The question is why the macro environment is cooperating with this decline. And the answer is uncomfortable. Multiple conflicts in the Middle East, specifically separate flashpoints that have been escalating in the region through mid-2026, have pushed energy prices significantly higher for countries around the world. Higher energy prices create inflationary pressure. Inflationary pressure makes it more likely that the Federal Reserve raises interest rates, or at minimum, holds them elevated for longer. And here's what that means for Bitcoin specifically. When interest rates are high and rising, capital has somewhere to go that feels safe. Bonds yield more. Money market funds yield more. The opportunity cost of holding a volatile asset like Bitcoin increases dramatically. Institutional investors who entered crypto with fresh enthusiasm in 2024 and 2025 are now looking at a landscape where traditional assets are once again competitive, and where artificial intelligence stocks and a resurgent IPO market are capturing the narrative attention that Bitcoin once monopolized. That last point is worth sitting with. Investor attention is a finite resource, and right now, capital and attention are both migrating. Not permanently, perhaps, but meaningfully. The on-chain data adds yet another dimension. Spot Bitcoin ETFs have collectively lost 51,726 Bitcoin over the past 30 days. At current prices, that's approximately $5 billion in assets walking out the door. The retail and social media community remains surprisingly bullish. One data provider noted that the bullish to bearish social sentiment ratio recently reached 2.23 to 1, the most bullish reading of 2026, and yet institutional capital keeps leaving. That is a textbook warning signal. When retail is optimistic and institutional money is exiting, history suggests the retail optimism is usually wrong. But here's what they're not telling you. This same signal, retail euphoria colliding with institutional selling, has appeared at multiple critical turning points in Bitcoin's history. And in every single one of those cases, what came after depended entirely on what happened next with one specific factor. We'll get to that factor in a moment. But first, I want to talk about the number that is generating the most debate among analysts right now. Subscribe to the Wealth Continuum right now if you want to be notified when we go deeper on the numbers that come next. Because this is where the analysis gets very specific. Let me be precise about something. The scenario that has serious analysts worried is not a simple clean crash to a round number. Markets don't work that way. The scenario that concerns the more technically rigorous voices in this space involves a sequence of events. And that sequence matters more than the destination price. Here's the roadmap some analysts are drawing. Step 1, the bounce we are currently experiencing. Bitcoin recovers from its weekend lows near 59,000. It stabilizes in the low to mid 60,000s. Relief returns. Short sellers get squeezed. Social media fills back up with optimism. Some technical indicators flash oversold recovery signals. This creates the feeling that the worst is over. Step 2, a potential relief rally extension. If Bitcoin clears and holds 65,000 convincingly, the market may push toward 68 to 70,000. This would feel very bullish to most observers. It would generate headlines about recovery. It would pull more retail capital back into the market. And that is precisely the moment some analysts describe as the trap closing. Step 3, distribution. For those who aren't familiar with the term in a market context, distribution is the process by which larger, more sophisticated market participants sell into retail buying pressure. They don't sell all at once, which would crush prices immediately. They sell gradually, absorbing the incoming demand from optimistic retail investors while quietly reducing their exposure. Prices stay elevated just long enough to make everyone feel safe, and then the floor disappears. Step 4, the impulsive move lower. If the distribution thesis plays out, some technical analysts are pointing to a target zone around $50,000 to $55,000 as the next major support region. Some more aggressive bearish scenarios reference 45,000 to 48,000. At current prices, that would represent a decline of somewhere between 15 and 30% from where we sit today. Now I want to be very clear about something because intellectual honesty matters on this channel. These are scenarios, not certainties. The analytical frameworks that produce these targets have track records. They are not random guesses, but they can also be wrong. Markets can invalidate even the most rigorous technical roadmaps when macro conditions shift unexpectedly, when institutional flows reverse suddenly, or when a catalyst emerges that nobody anticipated. What makes the current situation particularly complex is that the bear case and the bull case are both supported by real data, and that is exactly why this is so difficult. This is where it gets really concerning, and also where it starts to get genuinely interesting. Because here's the part of this story that the bearish analysts themselves are acknowledging, and it may be the most important thing you hear in this entire video. Hit, like right now, if you want to understand how the most brutal crashes in Bitcoin history actually created generational wealth for the people who understood what was happening. Here's the paradox at the heart of every major Bitcoin cycle. The most devastating crashes are also the most powerful setups, not despite the pain they cause, because of it. Think back to what actually happened after Bitcoin's most memorable collapses. In 2022, Bitcoin fell from nearly $69,000 to under $16,000. The narrative at the time was that crypto was finished. Institutions had abandoned it. Retail investors were wiped out. The headlines were apocalyptic. And then, from those ashes, Bitcoin ran to $126,000 in October of 2025, roughly an 800% rally from the bottom. In 2018, Bitcoin fell from nearly 20,000 to under 4,000. Same narrative, same apocalyptic sentiment, same declarations that the era of Bitcoin was over. And then the next cycle delivered gains that changed the financial trajectory of anyone who held through the fear. Now here is what I want you to sit with. Every single one of those buying opportunities felt terrible in the moment. They didn't feel like opportunities. They felt like traps. They felt like confirmation that Bitcoin was finished. The people who bought at those lows weren't doing so because it felt safe. They were doing so because they understood something about the structure of this asset that the fearful majority did not. Now, fast forward to today. If Bitcoin does find its way toward the 50,000 range over the coming weeks or months, and that remains an if, not a certainty, what does history suggest happens next? Standard Chartered's Jeff Kendrick has noted that ETF holdings have remained relatively stable since February, suggesting that the institutional foundation hasn't fundamentally collapsed. His view is that ETF inflows could recover meaningfully once market conditions stabilize. Investing, Haven's analyst consensus places Bitcoin's worst-case downside support around $45,000 to $65,000, but their central scenario still targets prices in the six-figure range before the end of 2026. The logic is straightforward. This is not 2022. The infrastructure around Bitcoin in 2026 is categorically different. Spot ETFs exist and have over $1 trillion in assets under management across the broader crypto ETF landscape. Corporate treasuries hold Bitcoin as a reserve asset. Nation-states are actively considering Bitcoin reserves. The regulatory framework in the United States has matured dramatically under the Clarity Act, despite its ongoing political debates. What that means is this. Even if the current correction extends significantly, the structural demand base underneath Bitcoin today is larger, more diverse, and more institutionally embedded than at any previous point in its history, which creates a scenario that very few people are openly discussing right now. If fear pushes prices lower, institutional entities with long time horizons don't see a crisis, they see inventory going on sale. And that is the silver lining that the bearish roadmap is inadvertently pointing toward. Stay with me for just a little longer because I want to bring this all together and answer the question you actually came here to have answered. So here we are. It is June 8th, 2026. Bitcoin is at approximately $63,000, recovering from a weekend low near $59,000. Spot ETFs have bled out $4.4 billion in 13 sessions. The Fear and Greed Index sits in extreme fear territory. Technical support near 60,000 is being tested, and a growing cohort of analysts believes a move toward 50,000, potentially lower, remains a live possibility. And I want to ask you directly, knowing all of that, what does it change for you? Because the answer to that question is entirely dependent on who you are as an investor. If you are a short-term trader, the current environment is genuinely treacherous. The 60,000 level is your line in the sand. If it breaks and holds below, the technical picture deteriorates rapidly. You need to know your risk tolerance and your exit levels before the market decides them for you. If you are a long-term investor, someone who measures time in years rather than weeks, the calculus is different. Corrections of 20, 30, even 40% have occurred in every single Bitcoin bull cycle. They have not prevented Bitcoin from reaching new all-time highs in subsequent phases. What they have done is create enormous entry opportunities for people who had the patience and the emotional discipline to act when others were retreating. The question you have to ask yourself, and I mean genuinely ask, not just nod along to, is this. If Bitcoin fell to $50,000 tomorrow, would your reaction be fear or would it be opportunity? Your honest answer to that question tells you more about how you'll perform in this market than any chart or analyst prediction ever could. What I know from studying market cycles is that the most consequential financial decisions are almost never made during clear, comfortable moments. They're made in the fog. They're made when the outcome feels uncertain, when the crowd is divided, and when the price action is messy. That fog is exactly where we are right now. And that's precisely why this summer, the next 8 to 12 weeks of Bitcoin's price action could define how the rest of the 2026 cycle unfolds for you personally. Before you go anywhere, I want to hear from you. Drop your prediction in the comments right now. Do you think Bitcoin holds above 60,000 and builds from here? Or do we see another leg down before this cycle's real accumulation phase begins? Tell me your target, whether it's 48,000, 55,000, or 75,000. I read every single comment on this channel. And here's one more question I want you to think about before you close this tab. If you had known in November of 2022 that Bitcoin was about to begin an 800% rally, what would you have done differently? That question isn't academic. The answer to it is the most important investing lesson this asset class has ever offered. Share this video with someone in your life who is watching Bitcoin prices right now and feeling either blindly optimistic or completely panicked. They need this context. The middle ground, informed, patient, strategic, is where the real opportunities live and most people never find it. If you're serious about understanding market cycles, not just the headline prices, but the structure underneath them, the psychology that drives them, and the data that actually matters, that is exactly what this channel exists for. Subscribe to the Wealth Continuum and turn on your notifications. Not because I'm going to tell you what to buy or sell, but because when the pivotal moments in this cycle arrive, and they will arrive, you will want to already understand the framework for thinking about them clearly. The biggest opportunities in any asset class are almost always found in the moments of greatest uncertainty. We are living in one of those moments right now. I'll see you in the next video.